wanted to start with a simple example of our noetic sequence. These lines here, the future lines are actually calculated from the sequence. Here you don't see how they're derived or how we came about them. That's discussed in the ebook, and and then also how we verify our Andrew pitchfork, which is very important, and that's discussed in the ebook. But basic pitchfork um, setup, we still follow that, which is as soon as that you get a higher high in a downtrend or retrace downtrend, you get a higher high. Like this is a high, lower high. This is a lower high. Then we get to a higher high. That's telling you, okay, give it a chance. It might be producing a pitchfork. At that point, we do a verification, and this one here passed real well, so we knew it was going to last for a little while. Um, and then we drew our events out into the future. So at this date, we actually drew it on Friday, October 14th is the first time that we could actually draw this whole pitchfork because we got a higher high and we did our confirmation and it looked good. So then we did our projections out into the future, and we could go from October 14th, 2011. This one here is almost a year later. What's that? June 22nd, 2012. But we could continue. This one lasts until it actually breaks some rules. We can continue. And these aren't all the turns or events, but they're most of the major ones. And it'll help us to get to that point. So let's just do one quick one here. And this one here is Friday, October 14, 2011. We see this here. And then there's a gap. We do not have another scheduled event. It's kind of hard. Let me see if I can zoom in real quick. No, I lose it on that. Let me see if I can catch it back there. We don't have a scheduled event until this November 6th of 2011. Okay. So we know that this market should, after showing this, and that's a strong bar that is giving us up bar, it should continue until the next resistance. And we have this Andrew pitchfork divided into quarters. That's what you see. These blue dash lines are each a quarter. And of course we got a center and external to the actual extreme edges. Now, so this one here shouldn't pause until it reaches the actual center line, which would be our next quarter above us, if we think that it's going to continue. So at this time, what we could do, and it's our event saying, hey, we're not getting a good turn until here, it should go up. We don't know how. It may jog a little bit, then go up. It may stay flat, then go up. And it may not even make it to the center, but it's going to turn on November 4th. So we want to analyze the week before, October 28th. Is that it? Yeah, hold on. That's the 4th. It's going to turn on November 4th, October 28th. So we're going to go ahead and enter. I like using options. This is a weekly chart. You can see up here at the top. So we're going to go ahead and do a buy, a call, and have it expire. If it's October 14th, let's see, November 4th when we return. So we might do November expiration because that'll be a couple of lines after. This is looking like a choppy area when you see that many events close to each other. So we probably want to get out before then if we make a little bit of money here. And what we'll do then is, let's go ahead and look at the options for, this is a Dow Jones Industrial Average with the 11th. I should have that down here. Okay. And, okay, that's not good. We'll try this again. This is only a test. It's October 14th, 2011. There we go. Now, the Dow is around, what do we got? 650, around 640 something. All right. So what does this one have? Yeah, 634. So 11,634. What we're going to do is go ahead and buy. I don't have all the Greeks up here. I mean, you can get into it and get into some more detailed trades, and if you have the money, go ahead and do some more fancier options and get a little squeeze more out of it. But right now, I'm just showing you it's very simple, um, and you don't have a lot of. The only drawdown or the most you're going to risk is how much you put in, and so the drawdown is not as bad. You can't, if you buy a call for $200, then that's the most you're going to lose. It's not going to be, oh man, now I'm down $800 because I was wrong. That's another reason I like the options. And then I like doing it on a weekly basis because you have time for that. It's a lot sharper and cleaner um, charting information. The quants and algos and hedge funds, all of them, it's harder for them to manipulate on a weekly basis. On a daily, oh, the drawdowns can hurt. Anyhow, so let's look at buying a call. We'll do it close to the money. The money means wherever we are is 117. I guess it's 100 and hold on, 116 to 117. So 106.34, 16. So 345 would be in the money. I can't afford that. So I'm going to come down. I'm going to say 285, and that'll be $285 because you have to buy 100. For those who don't know, there's 100 contracts. It's $2.85 a contract. So maybe I buy a couple of those for 600 instead of going to, and that'll keep you in a good area to make some profit. If you go deeper in the money, it may move quicker, but it's going to cost a lot more. If you can't afford it, you come out here, and it's going to move slower, and that starts getting into these deltas. It gets into the Greeks. Right now, do as close. You can afford two, fine. If only one, then okay, fine. We'll build the money up. But try to stay close to where the market is. So we're going to do this here. November 19th, expiration out. Remember, it's October 14th now. And we know that our first event is November 6th. So this gives us time, maybe another week or so beyond that. That we know that it's going to turn. So we should be able to get our money out by then. So here we go. We'll go buy it. It's two of them. Expiration 19th of November. And we've got two of them now open on the Dow Jones. Now what we're going to do is we're going to go ahead and add the weeks. October 21st. Let's see what happens. Okay, we get a little higher. Let's check see what happens with our money. I'll do this one day at a time, and you'll see the profit and loss change. Now we were down a little bit on the 17th today, 18th back. Let me go back for a second. Now that was 285. We were down. Okay, well we had to do so. We on one contract would have been down about 90. So 30%, which is about right. 600, we're down 200. We come back a little on the 19th, 20th, and on one day on the 21st, Friday 21st. So evidently, see, that was that drawdown here. Throughout the week, it came back down. Touched this, that support came back up, and we're good. Stayed in, and that's why I don't use stops on this either. I let this run out. That's another good thing about the options. That can run down to 0, but you're still open until it expires, and so that's good too. And you can't pass on a industrial average. It's not like, okay, now you got to go buy it, so you can't be served or have to give up that. So that's kind of good on the indexes. Like I said, this is just beginners. As you get more advanced, if you want to try it with stocks and everything, okay, but now you can be, exercise and all that, what you'll learn about if you continue with looking into options. But anyhow, so we're up a little on this Friday, but we're expecting it to go to the next resistance. No reason to stop here now, especially since it's bounced off of that. It may bounce off of this one here to prove it and go up, but we're looking for the green line, not necessarily at this time. I mean, that would be perfect. It's squaring some time there, If it's at that time, at this event, and at the green, then that's great. But we're not expecting that. If it touches it next week, bam, we're out. Okay. So let's go to another week. Add one on. Wow. Okay. Let's zoom in a little there. So it actually, on this week, on Friday, when it's about to close above the green, I would probably go ahead and get out on this trade. I would get out. We touched here. If it was during that day, which I'm pretty sure on Friday we closed above it some, pretty good above it actually, 100 and some. I would have exited that position before the end of Friday. Fridays are the days that we do. We enter on the end. Sometimes we exit and we enter the next position. But we're not going to get into that on this video if we see it at certain rules develop. So let's see where we are on with our position Friday, October 28th. This is the 21st. So go through, nothing happens on the weekend. Monday we're up a little. We're back down on Tuesday, so it must have jumped down. Wednesday back up. Thursday really pretty good. And Friday there. So actually Thursday must have been right up here at this tip. So if you're monitoring it daily, you may want to close. You could have got 650. So we're watching the price here. See if we go back a day. I'll show you. See, that was 650 on Thursday. So that was probably up here. That's not bad. I mean, that's only $20, but we'll go ahead and do our Friday exit at 6:30 this Friday afternoon, and we would have made $630 in 2 weeks off of, actually you just doubled our money because it was $285, so it would have been about $600, five something. But we would have still doubled our money and only risked that same amount. So on that one, it's a 1-to-1. But all of them really set up for that. And so this is the first one that we're testing. Thank you for paying attention.